All right, quick gut check before we start. If I told you that four companies, just four, are about to spend more money this year than the entire economy of Sweden on data centers, would you think that's genius or would you think that's insane? Because here's the thing, it's happening right now, and it's not even controversial anymore. Amazon, Microsoft, Google, and Meta are on pace to spend somewhere around $725 billion this year alone building out AI infrastructure. That is up something like 77% from last year, which was already the biggest capital spending year in corporate history. We are watching the largest bet ever placed on a single technology, and every one of us with a 401k or a brokerage app is now a silent partner in that bet, whether we picked AI stocks on purpose or not. So, today, I want to answer the question everybody's whispering about at Thanksgiving dinner and screaming about on FinTwit. Is this the AI bubble popping in slow motion, or are we just early to the biggest wealth creation event of our lifetimes? I'm going to walk you through exactly how we got here, how this compares number for number to the dot-com crash, who's actually winning right now, what could pop this thing, and most importantly, what you personally should do with your own money, regardless of which way it breaks. If you're new here, I'm all about making money less confusing and a lot less scary. So if that sounds like your thing, do me a favor and hit subscribe. Genuinely, it helps this channel more than you know, and I promise not to waste your time. Let's get into it. Every bubble, real or imagined, starts with a genuine breakthrough. That's important, so don't skip past it. The dot-com bubble started because the internet was in fact going to change everything. It did. They just paid about 8 years too early for that truth. The AI story starts the same way. ChatGPT launches, and suddenly a technology that used to live in research papers is something your mom is using to write a birthday card. Adoption speed like that is basically unheard of in tech history. Once that happened, every major tech company faced the same terrifying math problem. If AI really is the next computing platform, like the internet, like mobile, then whoever controls the infrastructure underneath it controls the next 20 years of profits. And if you're wrong and you underinvest, you don't get a second chance. You just watch a competitor eat your lunch. So companies that are normally allergic to risk started acting like poker players who can't afford to fold. That's layer one. This isn't random mania. There's a real strategic logic to the spending. Whether the math actually works out is a separate question, and we'll get there. Let's talk numbers, because vague statements like companies are spending a lot don't mean anything to your wallet. Here's the actual breakdown for this year. Amazon is guiding toward roughly $200 billion in capital spending. Microsoft is around $190 billion. Google's parent, Alphabet, is somewhere between $175 and $185 billion. Meta bumped its number up mid-year to a range of $115 to $145 billion. And Mark Zuckerberg's own explanation was basically, "We're funding superintelligence for everyone," which, sure, Mark. Add it up, and you're at roughly $725 billion in a single year from four companies. To put that in a number you can actually feel, if you make $75,000 a year, working every single hour of every single day for the next 9.6 million years wouldn't get you there. That's the scale we're discussing, like it's a normal Tuesday earnings call. And here's the part that should make you lean in. A big chunk of that spending isn't even going to chips anymore. It's going to electricity. Power has become the actual bottleneck, not GPUs. So when you hear AI stocks, you should mentally widen that to include utility companies, power infrastructure, and cooling systems too, because that's where a growing slice of this money is quietly flowing. Okay, here's the comparison you actually clicked for. Let's do this fairly, with real numbers on both sides, because most videos on this topic either scream, "It's exactly like 2000," or "This time is totally different." And the truth, like most truth in investing, is annoyingly in the middle. Similarities first. Back in March 2000, the Nasdaq hit an all-time high after climbing about 570% over 5 years. Then, it fell 78% over the next 2.5 years and didn't reclaim that old high until 2015, 15 years later.
At the peak of that mania, something like 1 in 7 dot-com companies were actually profitable. The rest were valued on vibes, page views, and the phrase eyeballs. Today, market concentration is arguably worse than 2000. The top 10 companies in the S&P 500 now make up somewhere close to 38 to 40% of the entire index, compared to roughly 27% at the dot-com peak. The Shiller-Cape ratio, which is a longer-term way of measuring how expensive the overall market is, sat around 38 to 40 earlier this year, the second highest reading ever, behind only March 2000's reading of about 44. Now here's where it gets different, and this is the part bulls will point to. Cisco was the NVIDIA of the dot-com era, the company selling the infrastructure everybody needed. At its peak, Cisco traded at somewhere north of 100 times earnings. Some measures put it well above that, while generating maybe $5 billion in free cash flow. NVIDIA today trades at something closer to 30 to 40 times forward earnings. Elevated, sure, but nowhere near Cisco's level, while generating tens of billions more in actual free cash flow. Pets.com had no earnings. NVIDIA reported over $120 billion in net income for its most recent fiscal year. That's not a rounding error. That's a fundamentally different company profile wearing a similar hot stock costume. So think of it like this contrast. The dot-com bubble was a bunch of people betting on restaurants that hadn't opened yet. The AI trade right now is people betting on the company that sells stoves to every restaurant in town. And that stove company is already wildly profitable. That doesn't mean the stove company's stock price can't still get ahead of itself. It just means the underlying business is a very different animal.
Let's talk about who's actually cashing checks right now, because AI stocks is doing a lot of heavy lifting as a phrase. NVIDIA is the obvious one. They make the GPUs that basically everyone else needs, and depending on the week, their market cap has flirted with $4 to $5 trillion, which at various points made them worth more than the entire GDP of most countries on Earth. Microsoft's been printing money off its cloud business and its OpenAI relationship. Alphabet's Google Cloud backlog reportedly jumped past $460 billion in commitments. Amazon's chip business alone is running at something like a $20 billion annual revenue pace. There's also a quieter layer of winners here. Think of them like the guys selling denim jeans and shovels during the gold rush instead of panning for gold themselves. Broadcom, which makes custom AI chips. Oracle, which has become a surprise cloud infrastructure winner off the back of a $300 billion OpenAI deal. Power and cooling companies most people have never heard of. This is a classic investing lesson worth remembering. Sometimes the safest way to bet on a gold rush isn't picking which prospector strikes it rich, it's owning the companies selling the pickaxes to all of them.
Here's where I want you to actually pay attention, because this is the layer most finance content skips. The scariest word in the AI trade right now isn't bubble, it's circular. Here's how it works. NVIDIA invests billions into OpenAI. OpenAI turns around and commits hundreds of billions of dollars to cloud providers like Oracle to build data centers. Oracle then takes that money and, you guessed it, buys billions of dollars of chips from NVIDIA. Round and round it goes. Analysts in 2026 estimate arrangements like this across the industry now total more than $800 billion. Some economists call this vendor financing, and it's not automatically fraudulent or evil. Companies have always helped fund the suppliers and customers they depend on. But it does mean the demand you're seeing reported in earnings calls is partly demand these companies are manufacturing for each other, not demand coming from you and me actually using more AI products. And this connects to a second, quieter problem. OpenAI itself, the company at the center of a lot of this, brought in roughly $13 billion in revenue recently, while reportedly on track to lose around $14 billion this year, nearly triple its prior year's losses, all while committing to well over $1 trillion in infrastructure spending over the coming years. That's not evil either. Plenty of huge companies ran at a loss early on. But it means an enormous amount of this capex is being funded by debt and promises of future revenue, not cash sitting in the bank today. Now, some of you are going to push back on me here and say, but the companies buying the chips are wildly profitable. This isn't Pets.com. And you're right, mostly. NVIDIA, Microsoft, and Google are genuinely profitable giants. But here's the objection I'd raise back. Profitable companies can still overpay for growth, and a February 2026 study out of MIT's NANDA research group found that roughly 95% of corporate AI pilot programs are producing no measurable return on investment for the businesses trying to use them. Only about 5% are actually making money back. A separate study from the National Bureau of Economic Research found the vast majority of firms reported no real productivity boost from AI yet, even while executives kept projecting big future gains. That gap between what's being spent and what's actually showing up on the bottom line for the customers of AI is the single biggest thing keeping serious investors up at night.
So what would actually pop this thing? A few realistic scenarios. One, an earnings disappointment from one of the big four, where the market realizes the E in that price-to-earnings ratio has stopped growing as fast as the price did. Remember, the bubble usually doesn't pop because valuations were high. It pops the moment growth stops justifying the valuation. Two, a cheaper competitor shock. We already got a preview of this back in January 2025, when a Chinese AI lab called DeepSeek released a competitive model reportedly trained for a fraction of the usual cost, and it wiped roughly $589 billion off NVIDIA's market value in a single trading day, the largest one-day dollar loss for any stock in history. That's how fast sentiment can turn when the story of nobody can catch up to us gets a crack in it. Three, the credit angle. A meaningful chunk of this build-out is being financed with debt, and if interest rates move against these companies, or if lenders start asking harder questions about whether the projected returns are real, that's exactly the kind of thing that turned a stock market correction into a full-blown crash back in 2000 and 2001. And four, honestly, just time. If 2 or 3 more years go by and most companies still can't point to AI actually improving their profits the way the MIT study suggests, patience runs out. Money is patient right up until the moment it isn't.
Okay, so here's the part where I stop being your market analyst and go back to being your annoying friend who used to be a financial advisor. Because here's the truth. I don't know if this is a bubble, and neither does anyone else confidently telling you they do. Nobody rang a bell in March 2000, and nobody's going to ring one this time either. So instead of trying to time the exact top, here's a simple framework I want you to run any hot stock through. I call it the 3-question bubble test. 1, is this company's revenue coming from real outside customers, or is a meaningful chunk of it circling back from its own investors and partners? 2, is the stock price growing faster than the actual profit? If the gap between those two lines is widening every quarter, that's your yellow flag. 3, would this company still make sense to own if the hype disappeared completely tomorrow? If the answer is yes, because the underlying cash flow is real, like it currently is for NVIDIA and Microsoft, that's a very different situation than a company that only makes sense if the story stays exciting forever. But here's my actual advice, and it's boring on purpose. For the vast majority of us, the right move isn't picking which AI stock wins, it's making sure AI exposure doesn't accidentally become your entire portfolio without you noticing. If you own a simple S&P 500 index fund, you should know you already have somewhere around a third of your money riding on 8 or 9 companies. That's not a guess, that's just what the market currently is right now. That's not necessarily bad, but it's worth knowing, the same way you'd want to know if a third of your diet was suddenly just one food group. Some investors are choosing to add a slice of equal weight index funds or international funds alongside their normal S&P 500 fund, specifically to dial that concentration back down a bit, not abandoning the market, just rebalancing the bet size. I have a whole separate video on how to actually check your own portfolio's concentration risk in about 5 minutes. I'll link it below. But the short version of my personal philosophy hasn't changed one bit because of AI. Keep investing consistently, keep your savings rate high, don't try to guess the top or the bottom, and let time do the heavy lifting instead of your nerves.
So, bubble or new era? Honestly, probably both at the same time, which I know is an unsatisfying answer for a video with bubble in the title.
The underlying technology is real, the profits at the top of the chain are real, and this could genuinely be the biggest platform shift since the internet itself. But the way the money is being financed, stacked, and lent between a small circle of the same players is exactly the kind of thing that has ended badly before, even when the underlying technology went on to change the world anyway. That's actually what happened after 2000. The internet was completely real. Amazon and Google are proof of that, but almost everyone who bought at the top still got wiped out first. So don't try to be a hero and guess the exact moment this turns. Just make sure you know what you actually own, keep your foundation boring and diversified, and let the next 5 years surprise you instead of ruin you. If this helped you make sense of what's actually happening with your money, subscribe and get on the newsletter below. I break down stuff like this before it hits the mainstream headlines. Stay diversified out there. Peace.